everyone, and my name is Mahdi Qudsi from the Vienna Institute for International Economic Studies, and welcome to today's event with the title Exporting and Investment on the Credit Constraints. And today's presenter is Walter Steingress from Bank of Canada, and the paper and the presentation is based on a preliminary version of paper with the same title, and the paper is not publicly available, but maybe you can send Walter email if you want to read the email, if you want to read the paper afterwards. And the event is part of the series Seminars in International Economics, and this series of seminars are organized by the Vienna Institute for International Economic Studies in cooperation with Research Center International Economics, or FIW. And these seminars in international economics, are intended to be a forum for presentations and discussion of current research findings in the field of international economics, which focus usually on three major topics: international trade and trade policy, foreign direct investment, and migration. And to give the housekeeping rules, we usually have in the first part of the event, in the first part of the webinar, we have about 30 to 40 minutes of presentation, which will be followed by about 20 minutes Q&A session at the end. So participants have the opportunity to ask questions, and if you want to ask a question during the presentation, it's better if you post it on your as a chat in the chat function. And if the question is very pressing, which is related to the ongoing slides, I will unmute myself and I will ask the question from Walter. And at the end, I will collect the questions so that you can also unmute yourself and ask your questions and raise your comments as well. And after the event is finished, there will be an online survey that will be sent to you via email, and we kindly ask you to participate in the evaluation that will help us to improve the series in international economics. And the most important note is that this event is recorded, and we will upload it on the VEV YouTube channel, so that anyone who missed today's seminar would be able to also see it at another opportunity. And the slides of the slides that will be presented today will be also available on the VEV website, which is showing the event for this seminar. So in order to introduce Walter, Walter is a principal researcher in the International Studies Division of the International Department of Bank of Canada. His primary interests lie within the field of international macroeconomics, and Walter's other research interests are also migration and international trade. Before joining Bank of Canada, Walter had an appointment at the Bank of France, and he earned his PhD from the University of Montreal and holds a master's degree from Boston University. Right now, he has a sabbatical period, and he's spending this period at the University of Innsbruck. So it's a very pity that we still do not manage to hold our seminars physically at the VEV, but we are happy that we can organize it online so that everyone else from other countries can also join our seminar. And today we kick off the seminars in 2022 with an interesting paper by Walter. So Walter, the floor is yours, please.
Thank you very much for giving me the introduction and giving me the opportunity to present this paper. This is closely finished to have a draft. So I hope I will be able to share the paper soon, but of course, I'm happy to share any versions that we have now in case you're interested. I also should say that this is a joint project with Kim from the bank, Rob from Lakehead, and Joel from Vanderbilt. I just realized that I didn't do the yearly leap. I am still in 2021. Sorry about that. Finally, this views, whatever I say here, does not reflect the opinions of the bank. So In this topic, basically, our main interest was to understand the joint decision of exporting and investment. And investment, what we think here of is productivity enhancing investment. And market size or access to foreign markets will matter for this investment or innovation for productivity, because you will get access to larger revenues that allows you to slide down the average cost curve and help you to cover the fixed cost to investment. And so usually when firms start to export, they get these larger revenues, and we see an increase in investment and productivity growth, what is usually called learning from exporting literature. However, in order for firms to take advantage of foreign markets and invest more, there may be the presence of credit constraints that prevents them from doing so. And in this paper, we're gonna try to identify what is the share of Canadian exporters that is credit constraint. So the way the literature approaches, that's an old question. Many people were working on this. We try to do here something different. So in general, we group the literature into two parts, and I'm sorry if we missed some important contributions here, but that's a non-exhaustive list. But in the first part, what we call the reduced form evidence is basically this literature looks at an exogenous event that changes the access to credit for firms, and thereby they then estimate that effect. So think about change in the interest rate policy, or or some credit conditions, or the banks have better lending, or there's a lending program. However, the difficulty here when you try to identify here the constraints is that suppose that you have a credit shifter, or let's take the precise example of having a lower interest rate. When you have a lower interest rate, some firms that were previously constrained, they will now get access because of the lower costs. However, at the same time, there's also the problem that even though firms that were not constrained, but just they didn't have, it was not worthwhile to pursue their investment opportunities given the cost to credit. So when you then lower the interest rate, suddenly the credit becomes cheaper, and then firms start to invest, but not because they were constrained, just now the investment opportunity makes sense, it was worthwhile to pursue. So this is the difficult to disentangle in that part of the literature, what comes from the changes in the access to credit due to constraints and due to investment opportunities. The other strand of the literature tried to tackle this problem by looking by basically modeling the financial decision. So they pursue a structural approach where then you do some targeting of moments, and basically the idea is here, so given the debt to asset ratio or other financial characteristics that are parameterized, then you can identify constraints or unconstrained firms from the structural, through the lenses of the model. However, that relies on these parametric assumptions of the model, and to what extent they are, you can fully capture the world. I mean, there are some assumptions to take. Here, what we're gonna do differently is that we're gonna have first a model that relies, that motivates how the firm and investment decision are correlated or come about, which is basically we take the Trefler-Lileva paper of 2010 and we merge it with the Manova paper of 2013. And then empirically, we're going to use the marginal treatment framework, and there we will be able to disentangle to what extent firms gonna invest more because of better opportunities or because they were credit constraints. So this will allow us to control for this endogenous selection. Then we will be able to see how many of these Canadian exporters are financially constrained. And then in the counterfactual, we're going to see, suppose we'll be able to alleviate those financial constraints, how much we would aggregate productivity would increase due to that. So in our, I don't go through the details of the model, but to give you an overview about the theoretical framework, it's basically a heterogeneous firm model, a la Mellitz, with a home and a foreign market, CES demand and constant marginal costs, and we consider here a partial equilibrium approach. So in the export decision, there will be a productivity cutoff phi 0x, which basically is the level where the firm is indifferent to enter exports or not, which will depend on fx, which is the fixed cost to x, the foreign market. So the higher the fixed costs, the higher the productivity threshold. And A star is the foreign demand, and tau minus sigma is the trade cost function. So the larger the foreign market, the lower the trade cost, the lower the productivity threshold. And RD will be the amount of debt you need to acquire to finance the export decision. But let me hold on here. At the same time, we will also have for the investment decision a cutoff where the productivity gain that you need to make in order for the investment to pursue the investments, where the firm is indifferent between investing or not, depends on again, A star is the total revenues you will get from higher productivity growth, which is A is the demand in the domestic market plus the foreign demand, A star in the trade cost. That is multiplied by PI. This is the probability that the investment pays off. So investment is uncertain. The outcome of investment is uncertain. And Fi is the fixed cost to invest. And D is again, so RD is the debt payment you need to make in order to finance that investment. And so we will have two sources of heterogeneity here of the firm in the firms. So they will differ in terms of the initial productivity, and they will differ in the initial financial conditions. So some firms will have a higher collateral, some firms will have a lower collateral. And this heterogeneity in the initial conditions is important, but we're gonna exploit that empirically. Also, what this model will imply is that the productivity gain from exporting will also be heterogeneous across firms. And the way this heterogeneity comes into place, let me guide you through this graph here. This is basically the Trefler-Leva paper in 2010, where they were looking at heterogeneous returns from exporting due to the NAFTA, in Canadian exporters due to the NAFTA trade agreement. So in the traditional Mellitz model, on the horizontal axis, you basically have initial productivity, and then you have the productivity cutoff phi 0x. So if you have a productivity higher, initial productivity higher than phi 0x, you're exporting, and if you are below, then you don't export. Now, but then you have the opportunity to invest. So, and given that when you invest, you will get higher productivity growth. So even though you may have initially a lower productivity than necessary to export, but with the productivity gain you get after the investment, this may make the joint decision of investment and exporting feasible. So if a firm with a low initial productivity but a high expected gain in productivity growth, they will start to export and invest. And the lower the initial productivity is, the higher is the productivity growth that you're going to need in order to make the investment and the export decision feasible or worthwhile. And this is basically then what Trefler and Lileva showed, is that once after NAFTA, the low productivity firms were the ones who had the highest productivity growth. So basically he estimated this line, or they estimated this line. Now we just take the same framework as them, but on top of it, we're adding these financial constraints from ANOVA. in this sense, firms can borrow. They actually, we oblige them to borrow from banks in order to finance the investment decision and or the export decision. They can do so by pledging collateral. The lenders and the investors, they are perfectly competitive, risk neutral. Everything is known. The only thing that is uncertain is how much the individual is the return. How much is the return from investment for the firm? So then, when the firm goes to the bank, it pledges the collateral, and then to pay for the fixed costs. And the bank will then offer a contract where it says the amount that I'm able to lend you. Then the repayment I ask you in case how should I say? Well, so if the investment pays off or pays out, I ask the repayment, and if the investment doesn't pay out, then I got the bank just gets the collateral. But so given that firms differ ex ante in this collateral, this will mean that based on this initial condition, firms with a lower initial collateral or lower collateral, they are less able to pledge, so that they will have a more expensive, they will be able to borrow less, or they will have a higher interest rate to pay. So these initial differences in the collateral will mean that there are ex ante differences in the access to finance. Now, this implies that on top of the same graph we had before, we now have this bank participation constraint. So suppose, so in the previous version, in the Tariffs Leva, it was basically assumed that if a firm has a high enough expected productivity growth from investment, it can easily finance it, or that the perfect credit markets, and it will do so. Now here, if that firm has not sufficient collateral, it's actually, they need to even higher productivity growth in order for the banks to participate and lend them. So we will have this declining. So as collateral of the firm increases, the banks is more willing to finance or requires a lower productivity growth for the firm in order to break even. And then at this point here, the firm will get, for example, credit, but the investment opportunity is not good enough, so it will not even invest. So the key thing, what we're going to need to identify then in the empirical part is this point here, because these are the firms that under a perfect capital market would have the sufficient high productivity growth that make exporting investment feasible, but because of insufficient collateral, the firm is not willing to lend them, and so they are financially constrained. So this will be what we need to estimate to get an idea of how many of those firms are financially constrained. So how are we going to do that? So basically, we're gonna look at heterogeneous returns from exporting after trade shocks. So we will have an instrument that shifts Canadian exporters into the export market exogenously, and then we're gonna be able to compare how the productivity growth varies for different types of firms. And what we should see is that those firms that were induced to export by the instrument, and then those who have they expect high investment opportunities, they're gonna enter and invest more. So basically, we will have a positive selection. So yeah, there is this choice, this unobserved choice, that if you enter to the export market, it's not true. there's the choice whether you invest or not. But if you invest, it must be because you have high expected returns. And when you have these high expected returns, because you believe you are very good, you will also increase your investment, and you may also invest more into not only productivity enhancing investment, but other physical investment. So for the data, we use the ASM, which is AMS, sorry, it's the Annual Survey of Manufacturing for Canada. And this has plant level details about production, exporting, and so on. The problem though at the AMS is that we are missing the capital structure, so we don't know the financial part. So for this, we merge this plant level data with the T2 tax returns. So we will get the balance sheet of firms for each plant for the year 2010. Now that there are some firms that have multiple plants, and we only observe the financial information for the plant level, for the firm level. So we assume that we apportion them equally across all the plants within the firm. But that's more or less a minor problem. We only have 134 multi-plant firms. Most of the plants in our data are single. Firms are single plant firms. I should say that this is manufacturing only, and the time period is 2000 and 2010. And now, so we're going to look at firms in the year 2000 that were non-exporters, and then in the year 2010, some of them became exporters and some of them remained non-exporters. So among the non-exporters who didn't choose to export, we see that those compared to those that chose to export during the period, they have a higher leverage, they have a lower productivity, labor productivity, lower total factor productivity, and they are smaller on average. So this already shows you that there are significant differences between those who choose to export and those who didn't choose to export. Also in terms of productivity growth is that those who became exporters, they have higher productivity growth in terms of labor productivity, in terms of TFP, they reduce the leverage ratio less, and they invest more into investment here to change tangible assets. Now, in terms of the estimation in the marginal treatment effect model, we were gonna follow the separate approach, where we're gonna estimate the equation of the productivity. So what determines the productivity return of a firm by its initial by its characteristics, and the control function, which depends on the propensity or the probability that you are choosing to export. And we're going to so in the separate approach, you estimate this equation for firms that choose to export and firms who didn't choose to export. The dependent variable will be productivity growth. That will be also the change in tangible assets as a proxy for investment, and whether you have the change in the leverage ratio, so whether you see that you're gonna change your financial characteristics given that you are exporting or not. And for the control function, we just use here a first order polynomial of how this probability to export fit into the return equation, but the results are robust if we consider a third degree polynomial. For the controls, the controls are just the initial conditions of the firms in the year 2000, which are the average characteristics of the industry in terms of the leverage ratio, the initial productivity, the initial sales, initial age, and our financial distress variable. And the way we define the financial distress variable is that in the year of 2000, how different was your individual or the firm's individual leverage ratio compared to the industry average. This takes into account this recent evidence by Levine shows that different industries have different optimal capital structures. And we are just saying that we consider here kind of the mean as the reference point and how far for each industry you are away from the mean terms of absolute, is considered you're more likely to be in financial distress. And the instrument that shifts Canadian firms into exporting is the changes in the UF tariff with the rest of the world. So the idea here is that the main export market for Canada is the US. Around 80% of the exports go to the US. And if the US changes its tariff vis-a-vis the rest of the world, and given that Canada takes advantage of NAFTA during the period, so tariffs were fixed, then if the US increases its tariff with the rest of the world, this reduces competition for Canadian firms in the US export markets, thereby increasing the probability of entry into the US export market. And this is something we find. I just want to show you in terms of which type of, there are two types. There was also the China shock. So for some industries, actually the tariffs of the US vis-a-vis the rest of the world declined. So those were, it's again wrongly headed. These were the industries where the tariff declined. So this was dairy product, it declined the most. So the US reduced the tariff by 4% or 5% on average over the 10-year period with the rest of the world. That's made the access to Canadian market in these industries more difficult. On the other side, in millwork, that was like a 2% increase of the US tariff with the rest of the world. That eased or made it more easy for Canadian exporters to move to the US. I also should say that an important for identification concerns, we need to check that these changes in the UF tariffs are not correlated with Canadian changes, because otherwise, if they would be correlated, we don't know whether it's foreign access that matters for Canadian plants or just they could source potentially cheaper inputs. And we didn't find here any correlation between changes in the US and the Canadian tariffs. And also these changes in the UF tariffs, they were not correlated with industry-specific characteristics of the plants in Canada. And here we see that indeed this change in the UF tariffs increases the probability to export. So when the US increases its tariffs with, let's say, China, then this would increase the probability that the Canadian firm is exporting. So this works. The instrument has predictive power. Then I should say that in the standard specification or in the initial size specification, what only matters for exporting in this specification is the initial size. So larger plants are more likely to export. And financial distress or initial productivity here is actually even negative. This is counterintuitive. And the reason why this happens is because size, TFP, and financial distress are highly correlated. So what we do here is we run an auxiliary regression where we net out the contribution of financial distress and TFP from the size. So size is capturing everything else that's not related to TFP and financial distress. And then we see that we get the usual result that if you have high initial TFP, you were more likely to export. And if you have better financial health or less likely to be financially distressed, you were more likely to export. So the interpretation here is that this basically works. The channel here is basically it works through size. So because you're more productive, you become larger, and that's why you export more. But we can't get rid of the size because we need the size, because the size has essentially has a lot of heterogeneity. Firms are very heterogeneous in terms of size, and when we're going to compare exporters in blue to non-exporters, the returns, we need that these two distributions are far apart and there is significant overlap. If I wouldn't have size, these distributions would be very similar. Because now in this marginal treatment effect model, what we're going to do is basically conditional on your propensity to export. So let's see, here the probability that you export given your initial characteristics is from the probit model is calculated to be 20%. And then we compare what is the productivity growth of firms that choose to export versus firms that didn't choose to export. And if our model is right, we should see that firms that were very unlikely to export, but did export nevertheless, so they had a low propensity, but they decided to export nevertheless, they should have a really high productivity growth because they knew that they're going to do well compared to non-exporters. And this is basically what we find, that the average treatment of the treated, so those firms who were induced to export by the instrument and then chose to export, they had a 35% productivity gain over 10 years. That's a huge productivity gain. However, the average treatment effect is 0, and the average treatment of the untreated is also 0. So the main productivity gains that we observe here is really from firms that were induced to export and then chose to export. And this is basically the declining line we saw in the model. So firms with an unobserved resistance to treatment, here is basically, think of this as firms with low initial productivity. Firms with low initial productivity, but decided to export nevertheless, they must have a high productivity growth. Yeah, they also have high labor productivity growth, they also have higher leverage, and they also have higher investment. But still now, we just estimated this declining slope here, but we don't know whether we are here or whether we are here. So in order to identify this point, and that will tell us how many of those firms are constrained or not, what you're going to need to do is going to shift this blue line exogenously. And the way we're going to do this is we just suppose that in the counterfactual, every firm has access to credit, so they're not financially distressed. So we set financial distress to 0. This will increase the probability to export. And this will then have changes the marginal treatment of each firm through the control function. And we're going to estimate the so-called policy-relevant treatment effect. And then we're going to see, so the constraint, so if I shift that down, what we should see is that the treatment effect where firms are indifferent between exporting investments or not, so this blue line should shift down to the brown line. And then we're going to have an intersection point, and this will going to tell us how many of those firms are constrained. Which is basically here. So the colors are reversed. So the red line is the initial marginal treatment effect, and the blue line is then the counterfactual treatment effect after the financial reforms, where everyone had better access to financial markets or credit. And then if we would go down here, this would suggest that around 15% of Canadian exporters are financially constrained in terms of realizing productivity gains. For the leverage ratio, it's a little smaller, it's around 9%, and for investment, it's a little larger, it's around 18%. Then we can also see what are the characteristics of those firms that are here on the left side constrained versus those firms that are we identify as unconstrained. We see that constrained firms have a higher leverage ratio, they are less productive, so lower labor productivity, lower TFP, and they are smaller. So given the model implied whether a firm is constrained, so we can't identify which firm is constrained or not, but among the set of firms we consider as constrained, the average characteristics line up quite well with the intuition that constrained firms are likely to be low productive firms and high leverage firms. Now, given this, so now in the counterfactual, after this financial reform, we can calculate what's the aggregate productivity gain that Canadian manufacturers would experience if we were to reduce all these constraints. So basically, putting the financial distress to zero, this would increase the treatment effect of, as we saw here, the blue line of many firms. For the constrained firms, it would make them lower to break even, and for these firms, it makes them higher because it increases the investment opportunities. And if we sum across the blue line, this will tell us what's the aggregate productivity growth after the financial reform. And here, in the financial reform, what we will get is that on average, or total, we get 2% percentage point productivity growth over 10 years. So this is a 0.2 percentage point increase per year. That's not much. However, and the OECD confirmed that again, that in terms of productivity growth, Canada was damn last among the G20. That percentage, the 10-year percentage point growth in TFP in this sample was only 0.2%. So this 2% would be very high compared to 0.8% realized. So even though it's low, but it would be a significant improvement to where to what Canada experienced over that period. We also did another reform where we looked at the trade reform. Here we were just supposing what would be the productivity growth if the US would increase the tariffs with the rest of the world. This would induce some Canadian firms to export, and they will start to invest into productivity enhancing investment. How much productivity growth we would get from that? If the US will increase 10%, that's quite high. If the rest of the world, we will get 1.7% productivity growth. And if we will do both combined, so no firm is financially distressed, plus easier market access because of higher US tariffs with the rest of the world, we will get 3% productivity growth. So trade reform and financial reforms are complementary. So by doing them combined, you will get stronger effects. But there is some correlation because they don't sum up to 1.9 plus 1.7 is not 3.6. And I should say here is that contribution is not coming only from firms that we are constrained, where we relax the constraints. It's only 30%. The rest of the 70% is that when we give access to better access to foreign markets, or less financially distressed, or reduce improve the financial health of firm, this makes investment opportunities worthwhile to pursue, and that's why we will have productivity growth. So to conclude, are Canadian manufacturers credit constrained from export markets? According to our analysis, around 17 to 18% of the Canadian manufacturing plants are credit constrained. The way we identify this is with this marginal treatment effect framework, where it's based on selection on gains from exporting. And we uncover a positive selection of exporting, so that firms that choose to export experience higher productivity growth, increase the leverage the most, and invest the most. To what extent does this reducing these financial constraints would increase productivity? So for the marginal firm that is that would actually increase the productivity growth by 15%. However, that marginal firm is quite small. So once we aggregate over all these firms, that on aggregate, it's a much smaller number, it's only 2%. And in terms of policy complementarity between the trade and the financial reform, They are roughly independent. So when you do those reforms jointly, then you will get the largest effect. So that's it from my part.
Thanks a lot, Walter, for this interesting presentation, and it's an interesting approach and interesting paper. Well, I have some questions, but maybe also the audience, they also have some question, but it may take time for them to raise their hands and show their questions or comments. So until then, I maybe raise my comment or question, which is, I mean, maybe it shows my lack of understanding or naivety, but the thing that I understand about the methodology is that firms with financial constraints, they are less able to export. So the causality comes from financial constraint. But in the methodology, you also use that those firms who are exporting are less financially constrained. So because of exporting, they have less financial constraint. It's like a dual causality. Once it goes from financially constrained to see how which firms are exporting, and then from the probability of exporting, you show that those who manage to export, they are less financially constrained. But maybe it will be better if you give me, or you give us a brief summary of the methodology.
No, maybe I was here a little bit. So how should I say? So if in the counterfactual, so before when we just estimate this red line, I don't know anything about who is constrained or not. I just say, that firms that were predicted by their characteristics not to export, but do nevertheless, they have high productivity growth, they have high leverage growth, and they invest a lot. But I don't know whether that could be because they were constrained or not constrained, or whether they're just a good opportunity. But in the counterfactual, then we say, suppose I improve your access to, I reduce your financial, I improve your access to credit. And then because of the access to credit, you're gonna export. And then because then you export, and then you invest into productivity growth potential. But the blue line tells me here now is what would be the necessary productivity growth that you need to break even, given your initial characteristics after the reform.
But how do you measure that? How do you measure this counterfactual?
How I measure this counterfactual?
Yeah. So for the red line, it's you're getting it from the estimation of exports, right?
So here, basically, you have the counterfactual. You get so this is the function of this blue line or red line. The blue line, I have the beta, the axis. So it's the betas of all the characteristics I have, plus. And here I have the propensity of exporting to the probit, the predicted values from the probit. And that functional form there's a functional form assumption here. And the blue line I get from the original piece, and the red line I get from the original piece. And the blue line I then get from the counterfactual piece. So I just re-estimate the probit, but now with a different value of financial health. I get new predicted propensities. I plug that into this formula, and I will get individual treatment effects.
Okay, so what is the financial health? Sorry for interrupting.
Okay.
Yeah.
the financial health variable is this difference to the average industry. So the idea is that, so the absolute difference between the firm's leverage and the industry average. So the idea here is to suppose you have no, but that's not, that doesn't mean that you're constrained or not. It's just something that shifts your access to credit. So this idea, suppose if you're very low, you have a much smaller than the industry average, then maybe, you know, it was difficult to get access to credit. That's why I have a low leverage ratio.
Right. And low leverage ratio is asset to what? Is it asset to?
Yeah, debt to asset ratio.
Debt to asset.
The long-term debt to asset ratio.
I see. Okay.
And sorry, just to finish on the upside, it could also be that, oh, I am so leveraged up. It's not, you know, I'm far away from the mean, but on the other side, and then I cannot get access to credit.
I see. Now I get it fully. So let's see. So if you want to continue your point, or we go to
No. I hope I did a manageable job in explaining that well.
Yeah. Now I understand it much better. Yes. Thank you. Nina, would you like to unmute? Yeah.
Yes. Walter, thank you very much for the great presentation. I myself was involved in one paper on how credit constraints and access to loans, bank loans, affect learning between firms. And we also found very significant effects. My question to you is about zombie lending. There are firms who get access to finance and are not, on a paper, are not financially constrained, but that's not because they're highly productive. That's because they're surviving, barely surviving, and then the bank gives them a loan. It's kind of, not really gives them the loan, it's just like revives the previous contract with a firm. So it looks like it's a new loan, but it's just like a revival of the previous one, so the firm doesn't die and the bank gets, you know, gets its money back. So did you account for this group of firms that are actually very unproductive, but, you know, have access to finance on a paper? Have you thought about it?
Yeah, so for example, so here the propensity score is the summary statistics that capture, you have a high propensity score, let's say because you have good financial health or because you have high productivity growth. So even though high initial productivity, sorry. So even here, we see that there are some firms who have high, potentially they are very financially healthy, but choose not to export. And the reason, the way we would interpret in the model is, well, they don't do so, not because they cannot, they are constrained, it's just because they don't have investment opportunities that makes it worthwhile. They prefer not to export. So that zombie firm, yeah, it continues to be zombie and doesn't want to do anything with the money that they get.
Okay, thanks. That's, thank you.
So in fact, it's observable through their other characteristics, right? We cannot see that characteristic that the firm has access to good friends in the banks, but they have low productivity and high amount of debt, right? Which accumulates year after year.
Yeah, so then, no, so the way the model works here is more a behavioral thing. Is that, let's say, now you have high debt, you have low productivity. So you are here. And then, yeah, 50% of a very high fraction of firms don't choose to export. But then, among those who chose to do so, they get really high productivity. Yeah, so maybe the discussion we had yesterday. So we would consider those as constrained.
Financially constrained?
Yes, we would those So because, yeah, you see that you were not predicted to export, but some of them do. Nevertheless, so you will get this high productivity growth if you do so. And now, if I would give you access to credit, we suppose, and that would lower the return and make you more likely to export. And so I think we would, yes, we would consider these firms as constrained.
Mm-hmm.
But point fairly taken that there can be firms that actually, you know, they. So ideally, what we would like to know ex post is that if we would have another source of a survey or something where you know that you are constrained, or where firms report that they are constrained or not, and whether we can that relate to our characteristics of that what we identify to be constrained are also the firms that report to be constrained.
Mm-hmm. So, Nina, do you have another question? Or so
No.
Another thing is how should the financial reform look like? So should there be any kind of limit on giving loans, or does it mean that banks should provide even more loans?
Yeah, so here it's just helicopter.
Mm-hmm.
That you know, there's no just providing at zero cost, right? Of course, you're right that if I give more money to firms, where's the money coming from? And yeah, that's not in yeah. That efficiency trade-off is that, of course, if you give them money and you take it away from somewhere else, we didn't specify what that something else is.
So how to improve the financial health of companies?
Well, here we just say, well, your debt to asset ratio is now equal to the average debt to asset ratio. So in some sense is, yeah, we give you so much debt, or we put away so much debt that your debt to asset ratio is equal to the average. Then you are financially sound in our framework. But any other, I should say that here, if any other credit access variable, not necessarily that what we have, something else might work as well. We only need that something that that is related to the access to credit.
So this average in the country or in the industry, is it aggregate or is it average across all firms? So does the size matter in this average or not?
So we have, I think it's 5-digit industries. It's like 200 industries. So it's relative to the average. So that would be, yeah.
Is it simple average or weighted average?
Simple average.
Uh-huh.
Simple average, yeah.
Okay. Okay, Nina?
Just one clarification. You said that you measure the financial health of a firm by the ratio of its indebtedness to assets. Is it right? When you say indebtedness, what do you mean? Because you use the tax data, and my first hint would be to use variable long-term obligations, because
we use long-term debt.
Long-term debt. So it's really the long-term debt. That's really the name of the. Okay.
Long-term liabilities or
long-term liabilities. That's what I meant.
No. Long-term debt over total assets.
Mm-hmm.
Okay, so it's okay. In a financial statement, it's a long-term liabilities, which are usually, you know.
Mm-hmm.
Well, if that's another credit shifter which is not perfectly correlated to long-term debt, we can try the long-term liabilities. Long-term
liabilities will actually tackle the issue of the investment, because usually firms are indebted long-term when they want to invest. So in this paper of mine, we used that variable, long-term liabilities, as an indicator of indebtedness for investment purposes. So that's one suggestion.
Yeah, and one more thing. What about the firms that exit the market completely? How do you control with not only exporting, but also the market?
Excluded from the sample.
Excluded from the sample.
Unsatisfying answer, but so the sample, I mean, there are more than 10,000 Canadian exporters, manufacturing plants. So we restricted only the analysis. So we threw out firms that were already exporting in the year 2000, because we don't know, we don't have any predictions of what continuous exporters will do given a trade reform, whether they should stay or go, and how that relate to investment. And those who exited, yeah, they are. You have to be there in 2000 and in 2010.
Mm-hmm.
If you exited in between, then you are dropped.
Mm-hmm. But maybe there is also a way to control for them as well, because they might have been financially constrained. That's why they dropped out. So in that case, the reform will help more, even more.
Yes,
right?
exactly. So that would be kind of what we have is a lower bound.
Mm-hmm.
Because the characteristics of those, presumably those didn't choose, were not exporters who exited. So that would then change only the characteristics of those who didn't choose to export, the white ones.
Mm-hmm. And so you said you have about 200 industries. Mm-hmm. And what you included as the trade measure is simply US tariffs against the rest of the world. So why don't you use something like the simple average tariffs or trade weighted average tariffs against Canadian exports? So I say that because you can use weighted. It's like if one industry exports half of it to the US and the rest to the rest of the world, then if you're taking weighted average or simple average, then it will show you a better picture. Because also US tariff policy is very similar to Canadian tariff policy in most industries. And what you observe is what you insert in the model is simply Canadian tariff rather than you get what I mean. It's not purely showing the tariffs faced by the Canadian exporters.
Yeah, so the reason why we opted for this instrument was twofold. So first, in the manufacturing, in the annual manufacturing survey, we don't see the destination where you're exporting to.
That's okay.
So
that's why I mean. That's why I said average total.
Yes, I guess I didn't. So maybe let me check. That it could be that the exports that the trade tariffs the Canadian exporters faced in the rest of the world. But because to the US there's no change, and we opted for the US because it's the largest, the most important destination, and almost everything goes to the US. Mm-hmm. But I worry a lot about the correlation between Canadian trade policy and US trade policy.
Yes.
Which are plot here, which we didn't see much correlation. Mm-hmm. But the other things we were looking at was foreign demand. So suppose demand would go up in the US, and given that Canada cannot affect US demand, that's a reasonable assumption. But it seems that we need something that's very long and persistent as a shock, and demand shock. So if we look at shorter distances in our framework, 2 to 3 years, then this thing doesn't work. I need 7 years or 10 years, and we think of tariffs as a more persistent market access shock, also compared to exchange rates. But I thank you for the comment on the.
Because usually precision is always the problem of our referees, and they say, why did you do that? Why didn't you do this? So That's why I thought it would
No,
be
no, no,
better
it would be
be
good to have
precise.
something else. Yeah.
Yeah. So any other question from the audience? Okay, then thanks a lot, Walter. Actually, Robert also wrote a message and he thanked you. And also it was a lively discussion in Robert's eyes. So it was very good. Thank you for the presentation, Walter. I learned a lot myself. So now I know how these kinds of things work. So it might be also stimulating for me for future research projects. Yeah, thank you. And thanks everyone for attending.
No, thank you very much. Thank you very much for the comments. It was very good. Thank you.
Yeah, thank you very much, Walter. Thank you, Nina, and have a nice evening.
Thank you, Walter. Bye.